right, guys, we're going to kick off our second quarter Q&A. We're going to go through all the different aspects of commercial, residential, and retail today. We have a bunch of preloaded questions that came in from different investors, which is super helpful. So thank you for those. Charles is here. He's always got good questions for us. He was here, somewhere here.
There
There he is right there.
Got the pup in tow.
Yeah. So you can't hear us? You couldn't hear me? Okay, there we go.
Okay, so we have to talk very loud.
Couple things we want to just kick off with first is the culmination of our intern program, which ends really next week at our summer camp.
Yep.
Right.
Yeah. So Nick, Hayden, Harris, not here right now, but like we really appreciate you guys coming into this summer. You guys were awesome. It was a lot of fun. You guys brought a lot of positive energy, and we're gonna have a lot of fun next week at Camp Greenleaf, volunteering together. But we appreciate you spending the whole summer with us and working on some projects.
Yeah.
So thank you.
So.
Yeah.
All right, some other parts here. This quarter, when we think about like what we're doing as a business, we really got focused on our commercial leasing. So we started a commercial leasing team with Lisa, Chastity, and Nyla. They're really getting all that stuff going right now. So it's a little bit of a bumpy road as we figure it all out, but it's going really well. So that's been awesome.
We've gone through at least 20 or 30 dozen donuts. Handing them out to our tenants. So we're enjoying our new leasing team. And
donuts and hugs.
Donut and hugs team.
Donut and hugs.
Right, Nyla? Yeah.
So, cool. So one, we want to just touch base on a couple trends that we're generally seeing. One of them is, commercial leasing, our lease momentum. So we signed 82,000 square feet of leases in the second quarter. We've currently got about 27 leases pending in our queue of stuff we're going to go through and look at, hopefully sign and get them on board. So
yeah, what we're finding is like, as long as we invest in the property, renovate, have the space ready and available, there's plenty of demand for people to come in and fill it in our suburban locations.
Yeah, we're seeing a big gap between landlords that are willing to spend money and landlords that are not. So there's movement in all the spaces when we're going to pay leasing commissions and offer TI dollars, the spaces are leasing up.
Right. And even some of our spaces that, we'll spend, say, 10 to 15, maybe $20 a square foot on flooring and paint and maybe some light modernization. But we're having tenants come in after we do that and spend 50, 100. Like we have a medical tenant spending close to $200 a square foot to occupy their space. It just makes them a stronger, stickier tenant to be in our space and makes the property more valuable.
Yeah. It's a little funky because they're spending more in their TI than we spent on the building.
Right. Yeah.
But it's been positive. So we're seeing a lot of momentum there, and just it's a process that typically takes a long time. So we put together a lease matrix that's hopefully going to enable us to make decisions faster. So we can basically respond to LOIs in 2 days, down from what I think the industry norm is weeks at a time. So we're trying to move things very, very quickly, which is always comes with a learning curve.
Right. I think this leasing matrix that Dave's talking about is a little bit of a kind of our secret sauce here at Greenleaf, which is our lens, our approach to commercial leasing, right? Which is different than other companies. And we tend to prioritize things that might be a little bit different than other companies and other leasing than brokers might prioritize, that we think are more valuable, that make the property more sellable and more sustainable for long term.
Yeah. So we're working through that right now. It's always exciting when things are sort of working and we're figuring them out and making them better. So that's been positive. All right. So next point we want to talk a little bit about too is just balance. When we look at properties that we've invested in and we kind of go through our quarterly reports, we go through how an asset is performing. We always start out with a business plan, and we're always a mix of cash flow to value add in two of those positions. Andrew, a lot of your deals are we're trying for cash flow,
right,
with organizational value add through longer leases.
Well, retail is usually in one of two categories, and mostly retail is always in the cash flow category. So we buy a Dollar General we used to buy a Dollar General for 7.5 cap, get 4.5 cap, 4.5% debt, and there'd be a spread between that. You'd cash flow for 5 years and then sell it. But then there's also the model where you buy something like we did this with IHOP. We buy the IHOP, we go from a 4-year lease to a 15-year lease. And even if you drop the rent on that IHOP, the longer lease is going to sell at a higher price. because all of retail is always going to always be sold based on the lease term. And so the longer the lease term, the higher the price is always going to be. And so with retail, a lot of times the value add, it's not construction. So with flex and with apartments, a lot of times the value add is going to be spending money fixing things. But with retail, it's usually just fixing the lease or making the lease longer. And so you're actually creating value with a piece of paper versus a construction project.
Yeah. So we look at our balance between those things, and like lease conversions are value add, our office conversions are value add, or we did a lot of apartment renovations. Those are all value add propositions. And we think about cash flow, we're doing a lot of debt issuances right now. We've done a handful of those deals. That's current cash flow. Most of our net lease stuff is current cash flow. Medical was current cash flow. And in some of our business cases, it doesn't always go to plan. It's almost never guaranteed to go perfectly to plan. But the big challenges we face are when something goes from a cash flow deal to a value add deal, or from a value add deal to a cash flow deal. Both of those are the opposite of what we plan for. Edgewood, which was a deal we did in Atlanta here, it was called Black Sheep Tavern.
Edgewood was amazing.
It ended up being a great deal,
You're
but we
right.
bought it as a cash
It was
flow deal.
eventful.
Oh yeah, we bought it just for just to get a monthly paycheck, and then the tenant, it was COVID, and the tenant could not survive COVID, and so the tenant was basically a disaster during COVID. I mean, the whole property, for those of us who were there, it was hard. It was basically gutted by homeless people and whatever. But then we managed to finally go through the eviction after COVID, and during COVID, all the evictions were horrible, so they took a really long time. We turned it around, we cleaned it out, and we actually went from $12,000 a month rent to $16,000 a month rent. And we also signed a 15-year lease. And the lease that we sold it with or had before we evicted the tenant, I think was less than 10 years.
It was like 6. Yeah.
6 years.
Yeah.
So we went from a 6-year lease at $12,000 a month to a 10 or 15-year lease. I forgot which one it was, but at $16,000 a month. So we created a lot of value, and that ended up being a home run deal. That was a great deal.
Yes. But it was a little bumpy and painful in the middle of it.
It was,
So
I think
that-
you call it brain damage.
Yeah, that happens a good amount in projects. They're not bonds. It's not guaranteed of how things are going to play out. And we have that going on right now with our NC Rate Bureau deal. That's an asset we purchased with the state of North Carolina Insurance Bureau in there as the single tenant. They're moving out at the end of August, and we're looking at what can we do to maximize value in that situation. We had reserves there to handle a lease renewal, but we didn't necessarily have reserves there to handle a full turnover and repositioning of the asset. That wasn't the business plan. But now we're going through that, and we're going to figure it out, just like we did at Edgewood and just like we've done at other properties. We'll figure that out there.
Yep.
We're in the middle of it right now, going through with different brokers.
And there's so many different options specifically on that building. It's a 2-story building, and it could be leased to one single tenant, right? For the whole building, you can lease a 2-tenant, 1 per floor. They're about 13,000 square feet per floor, or we can divide it up into 4 different suites or even more than that, based on what the demand is in the market. Generally, we found is that we can move faster and be more nimble with smaller tenants. So we would target more that kind of 5,000 square foot tenant, which would lead to breaking the building into 4 different tenants. That's kind of where we're leading right now. But we also have a full user looking at the building.
Yeah, we have a museum that's looking at taking the space for a 3-year period. So there's options out there. We've got to be creative in how we solve them and work through it.
Yep.
So, okay, next topic we want to talk about is, this has kind of come up, and we have some charts here. You want to put that one up to start with? We can start with just the pure revenue one, I guess, that shows our quarterly revenue. And when we think about how we're making investment decisions and what really the trend has been happening in the residential space, really 2020 to 2022. And I think everyone knows is now, like, rental revenues were excellent. And there are a huge amount of rental gains achieved in those periods where rental rates were going up 10, 20, 30% in some cases. And on our side, we saw consistent revenue, which revenue is harder to capture than rental rate gains. Revenue is if it was actually paid versus, hey, you signed a lease for something. So revenue is harder to capture. I think it's a more true number. But our revenue in 2021 was up 12%, and our expenses were only up 4%. So, like, inflation was still in check. I think if you listen to anything in the news, that it's changed from rents are going out of control, or like Occupy Wall Street rents were too high to now inflation is out of control. There's always something that there's always something that people are going to say is out of control, but inflation is now on our expenses that we have seen is about 19% a year. So we're seeing our overall expenses on the residential side up 2023 and 2024 around 19 to 20%, which includes taxes, includes insurance. We've talked on that a bunch. Includes operating expenses, utilities, all that kind of stuff. And that's where we really hit why we haven't really bought any residential is because the revenue is going lower and the expenses are going higher on some assets. It makes it a challenge. So we have a couple deals we've sold because of that, and we'll continue to look at deals that if the non-controllable costs get too high, we'll keep looking to exit those and capture what value is there.
In the meantime, the deals that we do have left, we have long-term fixed rate debt. I think our average maturity is 2028, 2029. Our average interest rate is in the 4s, some in the 3s. So we're in a really good position to hold. It's just, we're just keeping an eye on really the expenses.
Yeah.
And we've talked a little bit about that ratio because expenses are only really half of income. So if expenses are up 20%, it's not like it's 20% NOI erosion.
Yeah.
So
If expenses are half of income and expenses are up 20% and rent or revenue is up 10%, that's basically a wash.
exactly.
Right. But we do think not all groups have fixed debt for the next 5-6 years. So we do think there's going to be opportunities in it. We just haven't seen them quite happen yet.
Right.
We've heard lots of people be very negative to us that everything's going to be available.
Well, yeah,
we haven't seen it though.
You have to have the sponsor in a position that's basically ready to give up. You have to have the lender in a position that's willing to take a haircut as well because it's a distressed sale. And right now, some of the sponsors are losing grip and the lenders are taking it back, but the lenders are not willing to take the haircut to liquidate yet. So we're just not seeing it. Really, the market is still pretty stagnant.
I mean, it's still priced well. We haven't seen a big
and
change
still strong
on that. Yeah. All right. So let's go into just some of our residential deals and talk through our deal points on those. And if we have questions that come in, we have some that are here. If anyone on the call has questions to put in, we'll answer them. We have the chat up here to get started. So first one, and we'll kind of just highlight our numbers right now, is typically a discussion on our retention and our revenue growth. So revenue growth in the first half of the year was 7%. So it's pretty strong. I mean, that's good historically. It's not 2021, 12%, 13%, right? And we've had multiple quarters in a row now of 70% retention. So that's continues to be strong. And that's as the portfolio level. If we look at our deal specific stuff, one of the first ones we want to talk about is the Grove, right? So the Grove has been a deal that we're consistently have not made distributions on. And we always get questions on that, but the revenue there, we're up 7%, right in line with portfolio for right now. But we have some expenses that were higher, and our retention here was 54% for the second quarter.
Yeah, I mean, let's specifically about the Grove. That target of 70% versus 54% actual is the cost. It's about 100 units. It's 94. But so the cost, that's basically the cost of turning 15 extra units in that quarter, like times, call that $3,000, $4,000, sometimes $5,000 per unit. That's a lot of money that would be flowing through the bottom line. That's not.
Yeah.
So that's why we target that higher retention.
It's a lot of money. It's a lot of work from the team.
Yes.
To go add, there's only so many unit turns we are staffed and able to do in a given period of time. And as retention goes down, because we are trying to drive and grow rental rates, we can't have them be flat just because expenses are also going up. And then we're forced into a situation where we're doing more and more turnovers, and that gets, that's costly in itself as well. So that's, the story on the Grove, that's really been a consistent story for 4 years that we've had it. We've seen great revenue growth. We're able to sign new leases, but retention has always been in the 50% range to accomplish that.
Right. And so it will, as we keep an eye on that, if we can get retention to stable out, get some positive cash flow, we'll look to continue to hold it. If it just continues to be this kind of, low retention property with high turnover, we'll look to exit that.
Yeah. So another one very similar story to that is Fairway, right? That's here in Atlanta. It's 64 units. And that's one where we we're performing, but then we always feel like we get kicked in the butt sometimes. We're like, we get setbacks, and we've had 2 pretty big floods there because it is near a waterway in the city, and then that's a whole city fiasco that we're trying to work through and work with the community there. But we face challenges with low retention, and that just erodes our margins because of expense growth.
Yeah, and talking about fairways, so fairways in the QOZ, we bought this property because it backs up to the belt line. It's a big property, a big backyard to the property that goes all the way to the belt line. You can see the belt line behind you.
It's like 2.5 acres back there of unused land right on the belt line.
Right on this creek, that this was supposed to be an infrastructure project that the city was investing in for the last 20 years. And it still has not made it to this property. When we bought it, all the hype was that it's coming. This is the next section of the belt line. And
well, it's about a mile south of it right now is where it stops.
right.
Like that, the
Yeah,
grocery store that's about a mile south of Fairway. And it just hasn't made like the turn up to that area. And we've held it for a number of years now. And I don't know if they're going to get up there or not. I mean,
right. Yeah. So part of like this creek flooding, part of the, the stress of the area is that the belt line hasn't come through like we were investing into. So, we're looking at exiting that one as well.
Yeah. And we're optimistic that for Atlanta, the Beltline is a great project overall. It's a great project if it gets completed in under 50 years.
Yeah. It's on track for 50 years.
Yeah.
And we're barely halfway through.
Yeah. We're
I don't even think we're halfway
20 years in, I
Yeah.
think. Yeah. So, we have other deals that are along the Beltline and they've performed really well where it's in place. And those have turned into great, fantastic, walkable, easy to use neighborhoods. And we have done
Incredibly
15 deals.
Right.
Up and along the Beltline pass. So we're a big believer in it. And there's a huge amount of value for being on it and close to it. It's just the timing has to work out.
Yep.
So, yeah. One cool thing this quarter was our mobile home park, Barnes, which we got zoned for redevelopment. That was quite a learning curve that you and Stephanie undertook.
Yes.
Right. And going to the city meetings and council meetings to try and get that approved.
Yeah, so we started this really in August, where we met with the engineering team and design team and say, hey, what could we do with this piece of land? They put together some basic preliminary designs, kind of walked through the infrastructure. It said, like, this is what could potentially happen. Now let's go to the city and present to the city. We skipped one minor step in there, which was present to the community first. And we paid for it for about 90 days. We were criticized by the city and the county for not presenting to the community in the church with the pastor and getting everyone aligned with us. So we kind of had to backstop, present to the church, present to the community around us, get them on our team, which they did. They came around, they were on our team. They were great to work with. We just should have done it first. We got the approval. We got 38 townhomes approved. And once we really went through all the construction costs and analysis of like what it would take to actually deliver this through, we think it's more interesting to really sell that dream to the next guy and really realize the value of the rezone by letting someone else to develop it. So now we're testing out the market to see what that could be. Yeah,
we never really built anything ground up. We do a lot of renovation work, a lot of work with older buildings, but we typically have not done ground construction and infrastructure projects. So
there's
Ethan might disagree and say he's put in enough water lines to count, but
half this project cost was going to be just infrastructure, which is about $1 million to move the sewage from the property to city sewage. And then I would call it another $2+ million of roads and curbs and lights and power and all that stuff. So once we started looking at it, man, we thought we were just throwing up sticks and with roofs on them. We thought it was really simple. Yeah.
Yeah. So, but it is exciting that we got that approved. We're still, we still own the deal. We're still operating the deal. It's still working. But we are pursuing that avenue there on that one. But again, it's a big win. It's our first time we got something rezoned.
Did it in about 6 months. Yeah. Worked out pretty well.
Parlaying that experience into the forum. We're working on that rezoning there on the commercial side, but yeah. Other parts of residential that are going well and performing. We have our Kingstown sale that's coming up. That's a deal going back to our revenue and expense growth chart, where expenses there have just continued to grow on us. Our taxes consume 3 months of revenue, 3 months of gross revenue, which has been hard for us to move. We can't increase and we can't, and we're not interested in increasing rents that much on our residents. So that deal, the math on that deal doesn't check out really.
Yeah,
for
and
us.
really to realize the next phase of that, it's such a monster redevelopment and the basis being significantly higher with, in our opinion, reduce yields. And so we'll sell that again, just like Barnes, we'll sell that dream to someone else. We have a buyer that's willing to pay us a nice premium, and I'm working with him.
Yeah.
A lot of you guys got invested with our the seller's financing part of it. So we're excited about what he's going to be able to do, and we're happy to kind of go along for the ride in a low leverage position.
Yeah. We have, we have a lot of other residential stuff. There weren't a lot of questions on those because they're performing really well. The expenses have been in check. The deals like Park Hill, where we have camp coming up next week, City View and East Side Crossing, those have all performed well this quarter, and they continue to do so. And their non-controllable taxes and insurance are staying in check for the time being. So that part is going well.
Well, let's not forget about Amberwood. We've now owned it for over 10 years.
That's deal number 8. So that's
Yeah.
our longest owned asset that we have right now is Amberwood in Reynoldstown here in Atlanta.
Mhm.
So, yeah, I think that's mostly what we have for the residential side. I don't think we have any other questions in here. So, we're going to jump forward. Do you want to go through retail stuff?
Sure.
We'll start on that one. So it's an interesting time in retail right now. It's been an interesting 6 months.
Right. We're waiting for prices to adjust. They adjusted a little bit, but not a lot. But when an interest rate goes up from 3.5% to 7.5%, that should lower the price of a lot of our retail deals. But we haven't seen those prices being lowered to that amount yet. However, we're finally starting to see it. But what we're doing is we're doing something a little bit different. So in retail, you're buying a lease and you're buying a cap rate. And there is some due diligence around where is the property, where's the land, is it reusable, is it re-rentable? But ultimately, you're buying the lease, you're buying the credibility of the tenant, and you have this kind of back thought of, okay, if they do actually vacate, is it going to be replaceable rent? So what we're doing right now is we're focusing on Dollar Generals, and we did a huge data dump we looked at every single Dollar General for sale in the U.S. And we also looked at trying to put those top performing Dollar Generals at the top of the market that are for sale. And then also trying to find the best priced, best performing Dollar Generals and look at those as our subset of Dollar Generals.
Yeah.
And if 100 Dollar Generals are sold in our market, my hope is that we were always, the top 5 are always on our radar. So if the top 5 are on our radar, we're doing our job. So we're buying the top 5 or say we're buying 5 of the 10 top 100 retail deals. We're doing our job. So ultimately, that's our goal right now.
We look at things that when we consider something a top deal or a good deal, one of the main things is we don't want the most expensive rent. Like we don't want the property that has the highest rent in the market. We don't want the highest rent in an area. We don't want any of that. We want affordable rent. And then we want a tenant that has really good foot traffic.
Right. Well,
we
right
want to
now,
see that people are going to it.
I mean, any 10,000 square foot building, brand new. I mean, correct me if I'm wrong, but just bare minimum, it's going to cost $200 a square foot just to build a shell. So a 10,000 square foot building is going to cost about $2 million. Every single Dollar General we're looking at right now is well below replacement cost. We're looking at Dollar Generals on the low end that are 600,000, and we're looking at Dollar Generals on the high end that are 1.5 million. So everything we're looking at is below replacement cost, which means Dollar General cannot build across the street or down the street for anything less than what they have in the current building based on that rent.
The rent would be a lot more.
And the rent would be a lot more. And Dollar General does not, I mean, they're a low cost provider. And so part of their low cost provider strategy is you have to have low rent. And so honestly, the best deals that Dollar General has are the low rent Dollar Generals that are top performers. And those are the Dollar Generals that we're trying to buy right now. Low rent, top performing, those categories.
Cool. All right, let's, we had a question come in on Applebee's Seneca. So we want to talk about that one some. So we bought a few of these Applebee's. You've owned Applebee's for 10 plus years?
2017. So that would be
No, that's only 7 years.
it's only 7 years, sorry.
Darn.
But yeah, so we've been buying, well, then we brought that business to Greenleaf, and I think we've been through, how many Applebee's have we been through?
5 or 6.
We've been
6 or
through a
7.
lot. Yeah.
Yeah.
And like we've made some good
Oh, well.
money. Yeah, we've done well on them. And then we bought two Applebee's, one in Sumter, South Carolina, one in Seneca, South Carolina. And they were amazing when they bought. Seneca, South Carolina is a top performer in that market. And then
Yeah.
Sumter is also a South Carolina property. But they were both corporate owned. So they were owned by the actual franchisor, because Applebee's is a franchise. It's a franchisor.
Owned by Applebee's corporate.
Yeah. So it was actually owned by the corporation of Applebee's, not a franchisee of Applebee's. And so we thought it was amazing. And then along the way, Applebee's sold this portfolio to a franchisee. And then so we went from having the big, gigantic corporation as our tenant to this franchisee as our tenant. And, we could say,
Obviously their credit rating is not as good as
yeah,
the parent corporate company.
yes, and it's a little bit more difficult to deal with them. Their motivations are different, and it's just a lot different to deal with them. And sometimes a lot of their requests that they're making are not. There's just things we can't do.
Well, so they in business, they're trying to make their business perform better. So they requested, can we have a rent discount?
Right.
Their lease isn't up for another 4.5 years.
Just auto renewed. They're auto renewed in December. So yeah.
Seneca did auto
they got-
renew, right?
Yeah.
Yeah, but they have another 4.5 years on their lease right there.
Well, Seneca's 5, and then Sumter is about 4.
So we have a long way to go with these leases, but that doesn't mean at any point, any tenant can be like, hey, we'd like to renegotiate where we're at. And that's,
And we love renegotiation, because you give them a little bit of a rent discount, and then you get a longer lease, and then you're able to realize that value and sell the property for a higher price. And that's part of the game. But when you're asking for a rent discount, that's just not
that
reasonable.
math has to check out on both
The
sides.
math has to check out. And if the math, if you're asking for a 5 or 10% rent discount, great. But when you're asking for a significant rent discount, the math just doesn't work at a certain point. And so that's why we're trying to figure out what to do with these properties. But Seneca, I mean, underneath all of this, our Applebee's Seneca property is one of the top performing Applebee's in South Carolina right now. And they know it, we know it. And so,
I mean, you can still have a top performing deal and still ask for a rent discount.
Yeah,
You can always ask for a discount.
Yeah. Yes.
Doesn't matter how much you're spending. So
correct. We would have loved to have a 10-year lease on that top performing location, or a 15-year lease, because that would have sold at a nice premium, but we were never able to come to that conclusion. So right now we have a good performing property with a 5-year lease that cash flows really well.
Yeah. So we're in a good spot. We have these events that happen throughout the ownership period, and they're always something that we're looking at. If there's a opportunity to create or maximize value and capture that, we'll do it at that time.
Right. And occasionally we get calls, even though the property is occupied and leased, we get calls from tenants that are looking to come into the market to see if there's any turnover happening on the property, if they can come in. So that, that happened on one of our retail properties. It was actually a really interesting conversation. It didn't turn into anything as the property was leased and has years left on it, but it definitely is something that we have in our back pocket.
Yeah, there's people out there looking for second generation space or space that's not a custom build, because it's much easier to move in. It's already there. It's already zoned, already can happen.
Right.
I mean, there's always businesses trying to expand and I have the list, but there's a dozen brands right now that are trying to expand in the Southeast, and they're looking for the second generation space, because they do not want to build a new restaurant. They do not want to build 4 walls of it. They don't want to build a parking lot. They don't want to build a kitchen, because right now those are going to build for about, what do we think about $600 a square foot? And
They're big. Yeah, they're big numbers.
And you could buy something like that for $400 a square foot, or even $300 a square foot if you're lucky. So why are they going to build something when they could just buy something much less and then make it look like what they want it to look like?
Yeah.
Yeah.
So, okay. That was all the stuff we had for retail. It is an exciting point in time right now. There's this unique window where cap rates are creeping up a little bit because of high interest rates. And if interest rates go back down, those cap rates will go back down. So we have a moment in time here where we think we can really take advantage of it and buy some retail deals with significantly lower to no leverage, have a good solid cash flow right now, and then realize a good amount of value creation when cap rates do come down at some point in the future.
Yeah, a lot of these Dollar Generals, our approach with them is to buy them at high cap rates, no debt, close relatively quickly, and hold for that cap rate drop when interest rates come down.
Yeah, that'd be good.
Yep. If they don't come down, we have a great cash flowing deal.
Yeah, that we can hold long term. So Dollar General is operate on 5-year renewal cycles. So every 5 years, their leases are for the most part renewing at that point.
Right.
So, okay. The rapid fire continues. We're gonna go into the commercial stuff right now, touch base on a couple points we're going through right now, and then we'll go into some deal by deal stuff. The first one, it was something we really learned this quarter as we've been going through some of our office conversions. We're using terms like office conversion, industrial flex. And as we kind of really go into the weeds of it, what we're mostly buying is old call centers and turning them into occupied business space. When we divide things into 5,000 square feet, we can lease those to anything from a gym to a medical tenant. We don't have a lot of new office users and we don't have a lot of industrial users, but those are kind of the two market terms that are out there.
Right.
Right. What we have learned though is the office conversion permits. It's been a very talked about topic out there, but there's not a lot of it happening. Our CapEx team, April and Ethan, they're going to municipalities and saying, how are we going to do this conversion on this office space? And it's new for the municipalities. Like, we don't know. We never done any before. It's like, well, it seems to be popular. There's no one else doing it. So right now there's not really a lot of activity getting through to we're going to do the full permitting process. That doesn't mean there's not activity where people are taking space and going and doing whatever they feel like it and skipping that part. So.
And these conversations are getting earlier and earlier. You know, the first one we bought was Lakeside, which was 80% occupied. So it was a lighter lift and didn't really need those conversations to really happen. And then we move over to Forum and we've been working great with the city, but their advice was like, hey, listen, life can be way easier if you just do a rezone on this thing. Keep doing everything you're doing. Don't slow down, but just do a quick rezone. And we can say yes.
Quick rezone.
Yeah, quick rezone. I mean, it's gonna be 90 days. That's pretty quick.
Yeah.
While we build it. So we're in the middle of that right now. We got staff approval last week, and we'll get city council. We're working on city council approval for next month. And then this hub deal that's about to close. We're talking to the city 2-3 months ago, and the deal isn't closed for another month.
Yeah.
So just trying to understand what their vision is of the area, of the city, what they want to see, making sure all of our interests are aligned and that we're all singing the same song.
Yeah, we've had at least 6 or 7 meetings with them on the hub deal that's coming up that we haven't even closed yet. So working on getting that stuff is out in front of it as much as possible. Right.
And the conversations with the tenants there are 3 tenants there. It's about 25-30% occupied, has been basically relief, saying, oh, you guys are coming in spending money. We'd love to expand. We would love more space. And if you guys can outfit it the way we want it, which normally it's more warehouse space, so it's just demolition, which is great. We're not putting up a lot of walls and electrical infrastructure, and it's a win-win. So we're excited about the hub.
Yeah, that's going to be excellent. Very excited about that one.
Yeah.
So, okay, so digging into the weeds of operating each of these deals, we're going to start with Parsons, which is deal Elzer 65. And that's a medical deal we purchased. It was occupied. We were aiming for cash flow on that deal. We've still had cash flow. We still had distributions. We had one tenant there that plastic surgery center. They have a personal guarantee on the lease, but they moved locations and they made the strategic decision that they would stop paying their rent. Obviously conserves cash for them. They're able to move their location. But they signed a personal guarantee, and right now they owe about $200,000. There's a judgment against them for that, but we still have to go through the court process and with lawyers and stuff. I mean, you can file endless amounts of extensions as long as you want, until really you kind of at some point you're going to annoy the judge, and then that judge in that municipality is going to say like, no, we're doing this now. That's really what things have to come to, because you can file extensions and really indefinitely for.
Yeah, and
all sorts of reasons.
The final extension is really just filing bankruptcy, where now you're in line with a collections team, and there's a lot of people in line.
Yeah, but
they're still operating.
Yeah, they're personal guarantee, and they have a fully operating business at other locations.
Right.
So it's going to be a lengthy process. They do owe it. They have the money to pay it. We've been back and forth side negotiating as well if they'll just pay the amounts owed as they kind of rack up legal fees and doing it. But right now we're still fully through the court process, and we'll keep going through it. We backfilled the space though. As soon as we actually got them out, cleaned everything, we backfilled the space. So
back to 100%.
Yeah. So we have a full deal now, but that's a obviously a bump in the road that we did not plan for. So we try our best with all of our leases to have them in place and how are they enforced and make sure we're protected. But ultimately, we deal with individual actors that can, got to go through the process with them.
So this one suite, this bump in the road was about what, 11-12% of the occupancy.
Yeah.
They didn't pay for several months. So
9 months.
9 months. So that was part of the halt of distributions. Now we have a new tenant. I think we gave them 4 or 5 months of free
Yeah.
rent in that range. So we're not going to realize revenue on the suite until early next year.
Yeah.
And that's basically when we can start distributions back again, is really in 2025.
Yeah.
Once we really realize that revenue again. And then I mean, at some point we'll get that $200,000 and we'll have a party.
Or a distribution.
Yeah, or distribution.
Yes. Less of a party, more of a distribution check. Okay, next one we're gonna go through is Duke Medical. And this is a very, very nice building that we purchased up in North Carolina. We purchased it with a big chunk of vacant space, and we spent the good part of 2 years working on a lease agreement there with Allmac.
Well, so the first we were marketing it and we found a tenant that wanted it, but Allmac had that first right of refusal. So we went to them and say, hey,
We're going to lease the space.
We're going to lease the space. What do you want to do? And they're like, oh, we want it. So then we started the 2-year of, yes, we want it. Let us draw it. Let us design it. Now we'll sign the lease. Now we'll build it. And we're just in that process.
Yeah. And our a little bit of a unique situation with the loan there. We signed the lease. We had a construction draw there. They released the funds, and now we're going through the build out process on that lease. Typically, we're doing the build out process and then getting the loan funds. So it's a little bit in reverse, but it's probably one of the largest, like, kind of quality of tenants we've done something with, and it's a very large space. And they're going to spend, again, that's when they're going to spend more on their build out than we purchased the building for.
Yeah. So it's
going to be a very good long-term tenant that is there. So we're excited about that one.
So we have that basically being realized, plus the Duke, the main tenant in the building, they're 70-80% of the building. Their renewal is coming up mid next year. And once we get through that, that's when we kind of realize the business plan. We'll start looking at really the value of the property. Do we want to continue to hold this? Do we want to refinance it? Or do we want to sell it?
Yeah, at that point, we'll have the highest WALT, our highest weighted average lease term once those 2 leases are there. And that's just like the retail. It's the same as the retail strategy of when we have the highest WALT, that's when we have the highest value on the property and what decisions do we want to make. So Lakeside Flex. This is another good one. So Lakeside Flex is a very large deal. It's here in Tucker, Georgia. And again, it was office industrial flex conversion. We opened up a lot of spaces, and it turns out that mostly all medical tenants took that space. Right.
It's impressive with, number one, the demand, number two, the quality of the demand. It's been very impressive. It's a great location. It's right off at 85 and 285 and very accessible. But yeah, great tenants are coming in there. We're what, 90-ish%?
Yeah, we have 2 suites left.
Okay.
At 2 suites, 5,000 square feet each.
And
So 10,000 square feet total. So yeah, we're in very good shape there.
Yeah.
And we're going to business plan. Our TI and our allowances come in a little under budget. We still have 2 suites left, so we can't say we're fully know that number yet. Yeah, we're not done. We still have 2 more to go. But tenants there are spending right around $100 a square foot in tenant improvement. So if we're contributing 10% of that, 15% of that, they're making some major commitments. And for that, they've really wanted to make sure they have 10-year leases, because they can't go spend that much money and have a 5-year lease or a 3-year lease. They want to know that they're going to get to keep their space once they go spend all that money, which is a great tenant. That's a good relationship. So happy with those.
Yes.
As they're fully in, as they're fully paying, that's when distributions will start on that one. So yeah, we'll talk about Lake Park. That's the next one we have on here. Deal 74.
Also known as the IRS building.
Yeah. So we have a fun one on Lake Park. I mean, well, when we did our underwriting there, we knew we had a lot of older HVAC systems that we'd have to replace. And we're working through that and doing them kind of like as they come up. We have one right now that's a 12.5 ton system. So it's a big, that's a very
I call them
large
dinosaurs.
well,
Yeah.
so we're going to
Huge.
put another big one back
Yeah.
to fix the space. And, but the options we got were either use a helicopter or use a crane to get it in there.
We should definitely do a helicopter.
Yeah. Well, we're going to do the most,
Yeah.
we're going to do the most cost effective version of getting that in there. But it's one of these things that's, you know, we bought that deal knowing you have a lot of HVACs you've got to replace, and just really working through that. Each one of them is really a unique problem. And, HVACs have changed a lot over the past like 15 years and how efficient they are and how they go in. So every time we do one of these big improvements, it is a capital spend, but it's also makes it operates so much better than it did 15 years ago. So, we're working on that one. We have a lot of money in reserves here. We still have, some vacancy that we got to wrap up there. And then as soon as we get the HVAC stuff in and finish the vacancy, we're 89% occupied there. As soon as we wrap that up or know where we stand, we'll distribute down to our reserve threshold there going forwards.
And just to reiterate, like we were talking with Lakeside, also Lake Park, all these lake properties, but
This is Lake Park.
we're right. We're not done until we're at 100%.
Yeah.
So when we talk about vacancy, we're not talking about against pro forma, which we usually underwrite to 90, 92. We're talking about we will continue the work, we'll continue the renovations, we'll continue our leasing efforts until we're at 100% and we maintain 100%. So
Yeah.
that's always the goal, 100%, not
there's
92.
There's no short stop at like 90. Yeah, the 90, like, oh, we're 92%, we're pro forma full. It's like that doesn't,
Right.
that's irrelevant. We
It's
want to
not
be
good.
100% on all of them. So, okay, the next one we're going to go into is we always get questions on this one, and it's one where, you know, the game plan shifted in the middle of it, and it's a L081, which is Midtown up in Chattanooga. It's our largest property. Started as 280,000 square feet. And we purchased this deal knowing we could do some operational improvements. Our lending situation changed in the middle of that. And we're now doing one-off improvements in different buildings, realizing that value and exiting that specific property. So, or the specific building within there. We sold 3 buildings so far since we've bought it. We've exited almost 54,000 square feet of space at an average price of $119 a square foot. So it's positive. Our basis is in the low 80s, $82 a square foot. So we're making a very good spread. The negative or the downside is that all of those funds are going to the bank every time. And our banking relationship there is
Not the best.
Yeah.
Yeah. I mean, normally what we would do is on a property like this is as we sold each building, we would pro rata pay down the debt and then distribute to investors that capital gain. Unfortunately, with this banking relationship, they've basically lockboxed the assets. And so as we've sold off, they say, we want all that money and just keep paying off the debt. So our debt base is what, down in the 40s
Yeah.
now?
Well, no, it's our base on the deal. We have about 9, 10 million we have roughly $10 million of debt left, which is $44 a square foot. And if we were just to look at that compared to, hey, we're selling stuff for $119 a square foot, we've got around 38% loan to value ratio on the building, which is very good in the commercial space, but there's no number that's going to satisfy the lender and be like, oh, they have a low loan to value ratio. They're just going to keep, every time we sell a building, they're going to keep taking the cash to apply it to their loan balance.
And they also give us a hard time in reducing our payment as we pay down that loan. So we'll pay off $1, $2,
Yeah.
$3 million a loan. But we're still making a monthly payment. More is going to principal, which is fine. But
We're getting them I mean, one, you pay off a loan, you want to not only realize that payoff is fully as principal, but you also want to re-amortize the loan because it's at a lower basis now.
exactly.
You have a lower loan amount. So, hey, we want to redo our monthly payment. We've saved a lot of money on our cash flow by lowering that payment when we do make these payments. So it's good from a balance sheet perspective. It's not at all what we communicated up front. And there's not a way we can modify that loan outside of fully paying it off or refinancing it or selling the asset in full. Selling the asset in full, we would lose a lot of the value we're creating as we're doing it. And refinancing it right now it's just not a great time to do it.
Yeah, I mean, it's fixed at 5%, I
Yeah,
believe.
so it's like,
Yeah.
yeah, that's not the most optimal decision either. So quite frankly, right now, we're going to continue down this path of selling individual buildings, aggressively paying down the debt, improving our cash flow, and just keep that process going. We'll pay off the loan prior to selling all the buildings, and then we'll be left with a large asset with no debt. And we can decide at that point, is it an exit? Is it a refinance? How do we want to handle that? And it really just comes down to, what does the math say is the best thing to do? We'll present that to the investors at that time. But
Yeah,
the plan right now is
so
continuing.
really no distributions, no really intention of making distributions, and really just whittle down that bank loan till it's gone. So principal is safe. It's in a safe place because our bank loan is so low at 37% leverage, when normally you would say a bank loan in the 65% range. So
Yeah. No, quite. Okay. If there's questions on that one, or people want to think about that one, let us know. It's a more challenging one, and obviously a diversion from the original business strategy there. The next one is also a shift as well. We're looking at L088, which is NC Rate Bureau. We had the insurance agency that was in there. This is the similar conversation we were talking about Edgewood, where, we have a single tenant, they move out. It's not going as planned. What are we going to do to reoccupy that space? You're spending a lot of time talking with those brokers there.
yeah, so we have another state entity looking at doing a temporary lease with us. That was I think it's one of the museum entities of North Carolina. Raleigh is remodeling their museum, and they would come live with us for, say, 3 years. And we can basically find a longer term plan. It just buys us more time with them. And then we have a couple tenants that are looking at maybe a 25-30% of the space, but we have to break down the building and spend a lot of TI money. That breaking up the building and basically retrofitting for 4 tenants versus 1 is going to run us around $50-$60 a square foot, depending on what the other ask are, maybe as high as 70. So it's less ideal. We obviously would love a full building user. The building's very clean. It presents well. It's a desirable location. So we are having demand. So we're optimistic about that. It's just how we plan to timing and how we plan to divide it up.
When we did Edgewood, how long did that one take? You remember that?
Well, from eviction to,
Well, at
started
least this one, we're
construction.
not evicting it. It's been
Right.
Very much a open discussion they're working with. So we don't have to evict them. But even from that standpoint forward, it's still a lengthy process.
Yeah, I mean, it was definitely 4 to 6 months. Yeah.
Of time
It was a
to,
long time.
And, well, the good news is that we started working on this 3 months ago. We already have tenants users looking at the space. Rate Bureau, I believe, last month is September. So it becomes real then. And I think we definitely are exchanging LOIs already. So we'll have either a full user in mind or a part user in mind by the time they leave.
yes. Oh, so by the time they leave,
Yeah.
we're saying that's like in the third quarter.
Yeah, in the next
We'll have a good idea of what
30
we're
days,
doing.
I think we'll have a good idea.
And it still takes a little bit of time, move people in, lease abatement periods to get them going.
And the lease abatement period it's a negotiation that a lot of times we can move some of the improvements off to the tenant. So instead, if they want $60 a square foot improvements, maybe we only do 20, but we give them 6 months free rent. Or we say, listen, we'll do all 60, but you got to pay rent day 1. So it's just a haggle back and forth. It's just part of the kind of the whole picture. And that's where we use
And all tenants are different.
exactly.
They're in different spots of what they can and can't do. And
they don't have cash yet.
Yeah.
How it works.
so, that's another deal where it's not exactly in line with what the business plan was. But there is an opportunity to create value here based on how we get the tenants that are in there.
Yep.
So, okay, one more we want to talk about is Dawson Flex. And Dawson Flex is the largest lease we ever signed. So that one,
40,000 square
yeah,
feet.
we had a 40,000 square foot tenant that moved in there. They took an entire building. It has been a challenge. This is what we learned there was when we were purchasing assets, our surveys and kind of the interior designs of the building. There's a point in time where we can go discuss that with the city, but obviously we cannot do that if we don't own the building. The owners would not be, no owner would be keen on someone going to the city and pointing out your code violations right ahead of time. So that probably wouldn't go over smoothly, and that would probably kill any deal. So a lot of times we're buying deals. We know we're buying problems. We're trying to buy things that we can repurpose. And here it was a doozy going back and forth with the fire marshal to get the right sprinklers in. And I was saying we don't do ground up development, but our water main line that we put in from the main street back to this thing, maybe 200 yards long, was quite the endeavor to get that all connected. So we finally have all that stuff. We have our CO stuff there. Everything's in good shape with that tenant. They've been good to work with. Obviously, there's tension on any kind of stuff like that. Tenant wants to be in there and work and get their, be in there. So that deal, it took longer than expected from the permitting in the CO side, not from we signed a lease quickly. We got the tenant in there quickly. But the minor details of it, the fine print took a lot longer. So I think we learned from that, and we're using
Yeah,
that on the hub too.
And we're trying to get ahead of that, and especially with all our meetings on the hub.
But there's only so far ahead we can get because we can't just take stuff to the city before we own a building. So, and we can't really see the last time they took it to the city necessarily. So that's where we're at with Dawson. So, okay.
Questions, thoughts?
See if we have any questions that come in. That's our recap on all of the commercial stuff that we have.
Yeah.
And it's been going well. We've been signing leases, and there's lots and lots of work to do on that, getting people in and finishing out those leases. So it's an exciting time on the commercial space for doing this stuff.
In general, most of the municipalities, yes, they're cumbersome and relatively painful to work with, but they are excited to provide a solution to enable us to occupy these buildings and solve their vacancy problem in their city. It does take time. It's a lot of hoops to jump through, but they do want to work with us. We have to do it their way.
Yes.
Yeah.
Yes. We have to do it their way. And most time, like, one person can approve one thing. They're not just blanket approving stuff.
Right.
So
Yeah.
it's good. They're all different, but they're all working. I think the point about how most of them have not seen any real office conversions is interesting, because we've heard a lot about them, but we haven't seen a lot. So we're certainly on the front end of that experience with them.
Yeah.
So, cool. Okay. Well, all right. So question here is like, when will Dawson start distributions? They're not even starting to pay rent until Q3. So once we have Q3 in, and then we'll go through what does our full reserve stack look like on that deal. We still have a vacant suite that is there. So we have to have some amount of reserves for the unknown of what are we going to do with that suite. So we really have to have, the tenant's called Pure Air. They took the 40,000 square feet. They're in this fall. And then hopefully by the third quarter, we know what the acceptance is on the next suite of leasing it. We do not have a commitment for how many dollars per square foot we're gonna have to spend there. So we need to know that to put that in our reserve model before we can make a distribution. So that's.
So realistically, probably mid-year next
year. I mean,
year,
if that's a big
get
TI
someone in
number
there
and it's a
for
big lease, it could be the middle of 2025.
Right.
If it's a quick, easy move in, it could be the fourth quarter.
How many square feet? That's 20,000.
20,000 square feet. And that's purely set up as like warehouse right now.
That's a quarter of the property. It's 80,000 square foot property. Right?
So wanted to come in here, like, what's the status on Parsons? We went through Parsons, just working on the collection there. That's the main part. It is full. So we're back to the reserves and trying to collect our $200,000. That's outstanding. And the other question is, how is Summit Medical going? So Summit Medical is one where we bought it and we had two people that have moved out. We signed a really good lease there. So you want to talk about that one with Quest? That's
Palmetto.
Oh, that's Palmetto. Sorry.
Yeah.
Summit.
Summit's been full the whole time.
Yeah.
I think we had one small vacancy there, and now it's it's leased and it's been stable. The biggest thing with Summit, if you drive by the property or see it, I was by it a couple of weeks ago, and the two out parcels on front of it, one is Take 5 Oil, one's going to be like a chicken concept, maybe Slim Chickens. I can't remember. But they're building from the ground up. So it used to be kind of grass and trees, and then
like there were abandoned pad sites in front of the building that weren't being used, and now
long
both.
driveway. We were at the back of it, and now in front of us is just full demolition, construction site of them building these retail centers, which will make our property more valuable, more desirable. But we're in the middle of construction right now. We're not involved in these projects. We're just it's on our site. Yeah. Yeah. But yeah,
it's good it's good for anytime we see lots of development going around our buildings. We're always excited about that. So positive.
But Summit was one of those ones that, because it was a newer construction building and the building was newer, so all the infrastructure was new, HVACs, et cetera. We had good WALTs, the lease term, and good lease rates. When we purchased that building, we said that distributions were going to be light for the first several years as we get escalations. So we went into this property saying, hey, distribution is going to be 3, 4, 5% for the first, 3, 4 years. So we never intended to hit that 7% hurdle until multiple years from its acquisition. So right now, Summit is performing really on track, probably
Yeah.
ahead of plan. Yeah, that was always the plan.
So other general questions coming in, just what is the status of Johnson Square? Johnson Square is one of our most occupied buildings. We have really leased as much as we can there. We're not 100%. There's always little spots we can lease that are left.
Well, didn't we find a closet there that we leased?
We rented 200 square feet to one of the tenants that needed a storage room.
Yep.
So it was our team there is doing an exceptional job of finding ways to provide solutions for the tenants that are there and keep it as full as possible. It's the fullest it's ever been. I don't know if that's the right way to say it, but it's the most occupied that it's been.
Highest occupancy.
Yeah. I mean, high 90s, very high demand area. The main tenant there is this autism school that keeps expanding. They keep bringing in their partners and taking up more space. They've been a great partner to work with. So we're very happy with the property.
Yeah. Next part here too is, will Kingstown close? This question coming in, and yes, we were just finalizing that this week. Our target closing date there is August 8th.
Right.
So that is the plan on that asset. And we have our 1031 lined up for that. There's some people participating in that. So that'll be, the target there is August 8th to close and keep that transaction going.
Yeah. A reminder, Greenleaf is doing the debt. So that was a whole nother fundraise. We sent out subscriptions, I believe, this morning. We'll be calling on money between now and really next Friday with the intention to close really the following week on the 8th.
Yeah.
So very quick, very efficient, but we're excited about it.
Yeah. Okay. Another question from Brent. Do you think you guys will be bringing deals to investors that deliver 1.5 to 2x multiples? That's kind of a 1.5 to 2x multiple of equity, with 2 to 4 year holds and not distribution driven. And those are really pure value add strategies. And right now, in a 2-year hold period, there's not a lot that's available on a value add strategy. A 4-year, yes, but a 2-year, not particularly. So it would be on the longer side of that. A lot of our like office to flex conversions, as we look at those metrics, they're not immediate distribution driven. And we're going to hit a point when we do lease them up that we have to decide, are we going to exit them or are we going to finance them and hold them long term?
Yeah, I mean, the Forum, Lakeside, hub that we're doing right now, all these deals, it's a very heavy lift, a 2-year lift to basically renovate, get tenants in there, get through the free rent abatement period, get them paying rent. To Dave's point, doing that in less than 2 years is just frankly not possible in this market. And then once we get there, if the property did what we hoped it would do, it's performing well, it's cash flowing, making distributions, we're now looking at saying, wow, this is a great asset. Why would we ever sell this? So let's refinance, let's get long-term debt, and let's hold this thing for cash flow. So I think the answer is kind of like twofold. If it doesn't do what we wanted to do, but we got through the hard part, let's sell it and move on. If it does what we wanted to do, it's like, why not hold it?
Yeah. And we might see some on the retail side where we can take vacant buildings and occupy them. We're trying to build our operator relationships where if we can take a vacant building, the difference in value between occupied and vacant space is becoming dramatic.
Well, there's a lot of the vacant drugstores, the vacant around like Rite Aids, and those are generic boxes that are really hard to reuse. But if you could find a tenant to actually go in there, that's a brand, like a credit tenant who's paying real rent.
Do the work, sign the lease. That is an opportunity.
Those buildings, those drugstores have parking, they have visibility. I mean, even though it's a dark building, it was built as a premium piece of real estate. So the location didn't necessarily fail, but the business failed.
Yeah.
In the location.
We are looking at a lot of those. We're trying. They're kind of needle in a haystack to get them to work, because you've got to, 1, find a unique opportunity, and 2, find a business that can go in there that's going to create a lot of value for the piece of real estate. But if we can, I'm always optimistic we'll find stuff, and we're looking at them. But Brent, those would be the ones that fit that criteria. We'll definitely let you know if we get one. Next question. There seems to be a lot of private debt funds generated by syndicators. Do you see developing anything like this beyond what we've already done? We're looking for more opportunities that we can do it, but we're being selective with who we're going to put money out with.
Yeah, we want to, number one, we don't want to fund. We'll continue to do these deal by deal, which the Kingstown deal was the 4th deal by deal. And 2 is, there's a wide variability with sponsor and the person you're lending the money to. And there's already enough complexity in the deal to add the sponsor complexity on top of that, that we really want to keep everything arm's length in kind of our network. We don't want to just blanketly market to any person that wants money. I think we're excited about doing them. Our goal is to start doing one, once a month, and we just got to build that pipeline.
Yeah. Another fun question here is, what's your favorite memory? There's lots of them, but we have sumo suits for this evening, so I'm pretty sure seeing anyone put one of those things on is going to be quite entertaining.
Yeah.
So
My first place trophy from last year is still being challenged, by the way.
if you hold it with a sumo suit, it'll be more entertaining.
People are saying I
that
cheated
could be
last
my
year.
favorite moment.
They're still saying that, Dave.
No comment.
Do you want to go down memory lane?
I think that was good. That's
All
a
right.
good one, but yeah. All right. Well, thank you very much for watching. Thank you for the questions. We really appreciate that. And yeah, that's it. Thanks.
Thank you. Thank you all.